This TFMR podcast is brought to you by your friends at JM Bullion. Visit jmbullion.com for all your gold and silver bullion needs. Welcome back to the TF Metals Report podcast highlights for the first week of January 2021. As the week and the new year began, we got off with a bang. Big rallies in both COMEX gold and COMEX silver, and that was a major talking point on Monday, January the 4th. Gold on the daily chart, basing, holding, consolidating around the 50-day moving average for the last 2 weeks, finally surging higher late last week, and now clearly on a plus $52 day, breaking above and out of the most, I guess, conservative trend line that you could draw from the August highs connecting to the November highs. But clearly, for any traditional TA sense, that's the top of your bear flag or your bull flag. Downward trend in an upward market. And breaking out today, we just need to hold above there through the end of the week, which means we need to stay above 1900. Like to think we're going to do that, but again, it's a long week. Gold on the weekly chart, I wanted to show you this. It's the last 10 years. But again, showing you the significance of that flag. Again, we clearly broke out, whether it was from above 1,500 last year, above at the beginning of last year, above 1,800 later last year, whatever. Then you got this flag set two parallel lines, and now breaking out. An acknowledgement of that is going to bring a lot of TA guys in with their math, okay? And they're going to start projecting 23 and 2,400, okay? That's why. And then that builds on itself, like I keep saying. So that's why I want to hold this breakout all through the week. By Tuesday, January the 5th, our focus turned to the dollar index and concern that it was getting oversold and looked maybe to be ready to bounce. What impact would a big spike up have in the precious metals? Additionally, concern began to grow that the daily chart in gold looked a lot like it did back in the first week of November. We started to urge some caution, and as we found out later in the week, caution was needed. Now, why would I be so worried about that? Again, it's all about the dollar. Okay, here's your trend line again for the last 2 months. Really, since Biden was elected, we've gone from 94 down to 89, right? Or close to it, in a steady downtrend. Okay, getting more and more oversold, getting more and more people on the short side of the boat. We've had some spikes. I remember that just 2 weeks ago. We went from 89 and change all the way up to 91 in 2 days. Okay? A spike tomorrow could easily get us above this short-term trend line. Could also easily go all the way to 90 and a half. That's a full point. Okay, and why would the dollar spike? Because maybe the Democrats don't win 2 seats in Georgia tonight. Maybe the people of Georgia are pragmatic, and just like a lot of times people vote for, look at the House in the U.S. in the general election. People maybe voted for Biden, but they voted not for more Democrats. They voted for a Republican for their congressional district because they don't want the Democrats to have all this power. Okay, they don't want one party in charge. They don't want everything that comes with that, all the spending and the regulations and everything else on both sides. People aren't always keen to have all the Republicans being in charge either. So perhaps, again, not knowing just not really going along with what the polls say, maybe the people of Georgia are just simply pragmatic. They know what's at stake. They've been beaten over the head with $1 billion of advertising for the last 2 months. Maybe instead they vote one Democrat, one Republican. Or maybe they just don't want to take any chances. They vote 2 Republicans because they just simply don't want the Democrat. Remember, Georgia's a pretty conservative state. So what happens if instead of 2 Democrat victories, you get 1 and 1 or 2 Republicans, ensuring gridlock mostly? I mean, if it's 51-49 and the Democrats want to do something and they want to, go get Susan Collins or Murkowski or Mitt Romney or somebody to join them so that they can all of a sudden get some stuff passed. Okay, maybe that's what they'll do. But again, the Republican McConnell will still be the majority leader. Who knows what will come up? So anyway, more likely to get gridlock. If you get gridlock, you maybe get less spending And all of a sudden, a dollar that's been downtrend for 2 months and oversold bounces tomorrow a full point. That's what I think is possible. I don't know if I want to say likely, because again, who knows where that lightning is going to strike. But if it does, do not be surprised by a half point, 3/4 point, maybe full point green candle tomorrow that just takes you back up to 90.5 or so and then rolls over later this week. All right, so that's what your risk is overnight into tomorrow. If that's the case, if you get a spike in the dollar, the hell do you think is going to happen to the metals? And unfortunately, the metals were smashed on Wednesday, January the 6th. Not so much on a spike in the dollar, but in a spike in nominal interest rates as the bond market sold off sharply. Rates spiked above 1% on the 10-year Treasury, and all of this was used as cover to accelerate a down move in both precious metals, a move that unfortunately looks a lot like what we saw back in early November. To gold. Now, I try to dispense with some of the extra noise saying, just gave you this, okay? You have a downtrend top of the bull flag. That's the purple line. You have the uptrend off of the end of the consolidation phase, wipe out BS lows that the banks put on at the end of November. The intersection of those two lines, as we discussed yesterday, should be stout support. We also know that any trend line worth its salt, once you break out above it, you almost invariably pull back and test it for support. What had been resistance becomes support. That almost always happens. So, today's pullback to 1903 shows you that we hit almost exactly the point where you would have expected stout support. I told you yesterday to look for that. I also told you it was going to take incredible fortitude and cojones to get in there and buy some at that level. But if given that gift horse, you should look it in the mouth. I looked at options and tried to find one that was affordable, and there weren't any, which that tells you a lot too. So I didn't do anything more than buy back my silge calls that I got that partial fill on yesterday. I wasn't able to do anything else. And again, that's a pretty solid bounce. We should continue to expect both the purple line to hold as support if the blue line is broken, but I think we should continue to expect the blue uptrend to continue, at least for the time being. You can see this in silver, too, clearly above its bull flag line, which, again, if gold is following silver, well, look, it kind of pulled back, didn't make it to the purple line, but kind of got close to the red one 2 weeks ago, and has since gone up almost $3. Well, 10%. So why wouldn't gold continue to follow along and go up at least another 3 or 4% from here? Okay, makes sense. But anyway, pretty good job today of coming back. Still gives us with the possibility, and again, remember BLSBS on Friday, of a weekly close up above 2773, which is the target we're watching. Okay? By Thursday, January the 7th, we saw a small bounce in the precious metals, and we tried to be optimistic about the shares, given the way some of them were trading intraday. Okay, and then just a couple of other charts I want to show you. One, again, meaningful, I'll let you decide. I posted this chart earlier. This is that silge that I keep bringing up. I want to point out to you something interesting of the last 3 days, okay? We gapped up on Monday morning. And again, as we talked about yesterday, we do not want to gap all the way back down to 16 and change and create an island reversal. What we really want to do is get above this 1740 or 50 level. That would be fantastic. But that's not what I wanted. That's not why I wanted to show you this. Look at Tuesday. Okay, these are 30-minute candlesticks. Look at Tuesday. Big drop at the open. Okay, opened way up there and then sold way off, like 40 cents in the first 30 minutes. But then look at the accumulation and rally as the day went along. Wednesday, okay at the open, but then a big drop right about 9 o'clock. And then look at the accumulation and rally as the day went along. And then again today, big drop at the open. We didn't necessarily rally and accumulate all day long. But when I printed this chart, as you can see, this was 1707 and down 20 cents. But by the end of the day, we're back up to 1720 and down just 14 cents. So again, a day of accumulation, 3 days in a row. That's encouraging. You can see this in the GDXJ chart as well. Now, these are 15-minute candlesticks. But again, same gap up and then rally through the day Monday. And then you got the smash at the Tuesday open and then rally through the day. A smash after the open yesterday and a rally through the day. And again, a smash at the open today and then a rally through the day. When I printed this chart, it was 57.04. And the GDXJ actually finished right about there. So again, that to me is underlying bullish sentiment. Buying the dips, okay? I mean, think of it the other way. Think if we were spiking up every day and then selling off. Kind of like what we were doing back in early August, okay? Well, look what happened after that. And eventually the selling just takes over. This to me looks more like accumulation. And I think that's encouraging, obviously. And on Friday, January the 8th, our biggest concerns and our worst fears from earlier this week have been realized. Back in early November, after the U.S. general election, COMEX gold spiked, got above its trend line, appeared to be breaking out even above its 50-day moving average. On Monday, November the 9th, the vaccine news from Pfizer was used as cover to completely reverse those gains and smash gold for $110. Earlier this week, rally to begin the year in COMEX gold, took it above its trend line, took it above the 50-day moving average, and yet here they came again, using a rise in interest rates as cover to smash gold again for $110, this time over a 3-day period. It's going to take a while to get our feet back under us, and I'm afraid at least through the next FOMC meeting, that will be 2 weeks from now, we're probably going to have to tread water and try to build some kind of foundation. It's no fun, but it's all part of the process and does not change our forecast for a pretty solid 2021 to come. It may not play out exactly as last year, but the macro conditions that have driven prices for the last 2 years continue and will continue to drive higher gold and silver prices in 2021. Thanks for listening to this week's highlights from TF Metals Report.